Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
This episode is sponsored by our friends at YCharts. With the Fed's recent move to cut rates, there's never been a better time to dig into how markets react when inflation cools off. And YCharts just released the perfect research on this topic. Their latest white paper dives deep into how different asset classes like U.S. stocks, international stocks, and real estate have historically performed when inflation settles into the Fed's target range. For asset managers and advisors, these insights can be important for positioning portfolios and fund strategies in this environment. YCharts answers the big questions like, how often does CPI land in the Fed's target range? How do various asset classes perform when it does? And which asset class tends to outperform the rest? Grab your copy with the link in the show notes to unlock exclusive access to downloadable charts and powerful data you can use to up your game when communicating with clients as we wait for the Fed's next move. Don't forget, get 20% off your initial YCharts professional subscription when you start your free YCharts trial and tell them that Meb sent you. New customers only. What's up, everybody? Our guest today is Rob Citrone, the founder of Discovery Capital Management, a macro hedge fund, invests opportunistically all over the world across all asset classes, emerging, developed markets. Rob got his start at Fidelity, was also later a Tiger Gub based on his time working with Julian Robertson at the famed Tiger Management in the 1990s. He's also a fellow University of Virginia Wahoo and a minority owner of his hometown football team, the Pittsburgh Steelers, who happen to be playing my Denver Broncos this weekend. Rob, welcome to the show.
Great to be here, Meb. Thanks for having me.
How are you feeling about the Steelers this year? For me, it's been a long drought since the Manning era of the Broncos, but what do you think, 2024?
We have a really competitive team, and if we get reasonably good quarterback play, we're going to have a chance to win it all.
What's your most memorable Steelers moment? Could be childhood, could be recent.
Well, my daughter got engaged at the stadium last year on the field right before the game playing the Raiders, which was the 50th anniversary of the Immaculate Reception. And really sad in a sense that Franco Harris passed away a few days before that. And Franco was a good friend. My family was one of the founders of Franco's Italian Army. So I used to go to the games as a young kid in an Italian Army helmet. And Franco was going to bring the ring out to her before the engagement. So I get a little emotional about that, but that was really a special time.
Yeah. One of my favorite pieces that you put out, which you don't see too many macro hedge fund managers last, a decade in my world of public funds, half of funds disappear. And you guys just had your 25th anniversary. So first of all, congratulations.
Thank you very much. We're very proud of that.
But the first two bullet points I thought were really thoughtful in this piece because it wasn't talking about here's my amazing trade, here's why we've just crushed it over the decades. It was really about, investment management as a business and entrepreneurial career path and kind of how you got your start. Talk to us a little bit about how it feels to have survived, any battle scars, any lessons learned over doing this for that while.
Well, I think the first thing is you have to love it. If you don't love it, you're not going to last in this business for that long. And the second thing is that you have to have a competitive advantage and you have to know what that competitive advantage is. And you have to play to that strength. It's hard to do sometimes, but I was very fortunate to learn from two of the best. I worked with Julian Robertson for almost 5 years, and then I managed a lot of money for the Soros family and for Quantum. And really for the first 5 or 6 years, I would just manage whatever I could convince George to put in the book. He called it the back book. And, I would put $100 million position in the fund. I'd put a $2 billion position in Quantum. And I really learned a lot from both of them. They're totally different kind of investors. George is a master trader. Julian is a fantastic long-term investor. And I learned a couple things from them that I try to emulate. And the first thing is that, when you lose a little bit of conviction in any trade, just get out. Don't take 20% off. Don't think it's going to get better. Just get out. And the second thing they both did is they cross-referenced anything. If I gave Julian an idea in Brazil, he'd call all the 4 partners we had in Brazil, or he would try to talk to anybody he thought knew something about it. And George did the same thing. I remember sitting in George's office one time in 2008. Obviously, it was a really, really tough year. We had a big year in 2007. 2008, we were down in October, and it was right after the Lehman crisis. And he said to me, Rob, you're down 25%. how are you going to make it back? And I pointed out, I said, look, we have a lot of positions that are money good, credit that trades at 20 cents on the dollar, that in 2 years will be at par. We're going to make a lot back. And we, made a 75% year in 2009. But it was very interesting because he said, what are you worried about? I said, well, I'm really worried about Eastern Europe collapsing. And if that collapses, Western European banks are going to collapse. So the whole thing is just going to blow up. And he said, well, what can you do about that? And I said, well, the IMF has a program specifically they can lend into Eastern Europe, but they need the Western European countries to support them, and particularly Western European banks who owned a lot of the Eastern European banks. They need to not take any capital out. And he said, that's a fantastic idea. He says, let me get Gordon Brown on the line. So 2 seconds later, Gordon Brown is on the line, and we're pitching the idea of what Europe needs to do to kind of stabilize the situation in Eastern Europe. And 2 days later, it shows up in the Financial Times, here's Gordon Brown's plan to save Eastern Europe, and it worked, and I'm glad it did. And the Rolodex that Julian and George had to just contact people around the world on different ideas was fantastic. And we kind of developed that here at Discovery and over my years at Tiger and Fidelity as well. So maybe not to that extent, but especially in emerging markets, we can kind of do that.
You see some of these graphics nowadays where they have like the ideal quarterback, and maybe it's got Peyton Manning's brain and Brett Favre's scrambling ability. If you were to look at those guys and say, all right, I'm building the perfect macro manager, and really pull out the highlight, what is the key trait that kind of defined your mentors, partners there?
I think it was conviction in their ideas and their beliefs. They didn't let, positions that may go against them in the short term, they didn't let that deter them if they had a strong conviction in it. I can remember, positions with Tiger. The first day I walked in, it was during the Mexican crisis in 95, and we put on 2 shorts in Mexican toll road companies and construction companies, and they both ended up going bankrupt. In fact, when I left 5 years later, we still had one of them still short in the book. At different points in time, those trades were against us by 50, 60%. And Julian said, look, as long as you have conviction and your thesis is still there, you're going to stay with it. I think it's that. I think they're really great risk takers. They're not afraid of risk. You have to manage risk. You got to take risk. You can't run from risk. And I think today, in today's world, what I see are a lot of investors that are just afraid to take any risk. And so they have very mediocre returns and try to have very low vol strategies. But you really can't build any long-term wealth with that kind of strategy, in my view.
Julian's obviously passed away, but if you were to ask people, they say, what's Rob's investing superpower? Similar? Same idea? What have you honed over the past 2 decades?
I think I do have the ability to take risks that both of them have, and take it in a calculated way, but really put down the pedal when the opportunity is there. So it comes around every 10 years, an idea that just really stands out. And I can remember calling George in 2013 in the fall and saying, George, shorting the yen and going along the dollar is the best trade I've seen in a decade. And I'll tell you why. The central bank governor was leaving in 2014, and I had met with him a number of times. Shirakawa was his name. He really thought he was like a Bundesbanker, and he ran the tightest monetary policy in the world. He didn't realize how tight it was because rates were very low, but the real rate was very high. So the nominal rate was low, but the real rate was very high. And he wanted to meet me because he spoke great English, and he was always interested in what's happening in the rest of the world. So I would talk about emerging markets and the U.S. and everything. And so we had some great meetings. But I knew the new central bank governor would run much easier policy, and they'd have a reflationist policy. Now, we got a little bit lucky in that Abe came in as the prime minister, and he was really kind of goosed it up even more. But, we made $1 billion shorting the yen, and George made $1 billion shorting the yen. So those things come around every 10 years. And I think there's a trade today like that, and that's Argentina. I've been to that country 57 times over the years, starting first time in 1991. I've seen the ups and downs. We made money on the long and the short side. But this guy is revolutionary in what he's doing. And he has the support of the person on the ground and the person in the street, which is rare. You don't have big reform programs like this where the average person supports him. So it's not going to be an easy task, but he's off to a great start. Asset prices are incredibly cheap. There's a lot of runway there. And so I think equities can be up 4 or 5-fold over the next couple of years, already kind of doubled so far. Bonds, which yield 25% in dollars, will be down to sub 10. This is really a once in a decade kind of opportunity. So when you have those opportunities, you have to take an outside position in them and do it in a thoughtful way. And keeping liquidity is very helpful. So in Argentina, as an example, we have some debt, we have some local currency stuff, we have some equities, and we do it in a way that we can be as liquid as possible, but yet have a fair amount of risk on. And we did the same thing with the dollar yen, where part of the position was in forwards, but a big part was in options, because we couldn't take that big a position and take the risk and not have the downside. So we put a lot of it in option form. It was a very liquid option market, and the vols are really low. So There's different ways to do it in different markets and different opportunities, but these come around every 10 years. And if you don't take advantage of them, then it's very difficult to deliver outsized returns over a long period of time, which we think we've done.
Let's stick on Argentina for a second, because, I think particularly mostly American investors over the past 15 years have been warm, cozy, fat and happy, hanging out in the S&P. But, that's not always the case. And talk to us a little bit about this Argentina opportunity. One of the things you mentioned in your 25 notes was being able to draw on that experience. So you mentioned going to Argentina over 50 times over the years and being able to kind of look at this infinite menu of investing opportunities and say, okay, this is getting interesting. Because right now, if you look at the Argentina, I think there's one ETF left that invests in Argentina. And most investors, if you were to say, how could you even invest in Argentina? They're like, I have no idea. At what point did it start to become interesting to you? And then at what point, was the new president, was he really the fulcrum kind of moment, or was it building over the past 2, 3, 4, 5 years?
Well, it's really been building over the last kind of 18 months or so. We took the view that Argentina was in disarray. And we felt that the new president coming in would change and had much better policies. We didn't know who would win. And we thought Milei would have the best policies, but it was also the highest risk. Would he get the people's support? Would he be able to get things through Congress? What would he be able to do? And people thought he was very radical. He's turned out to be, just a great politician, convicted in his ideas, a great economic team he put in place. He really has gone beyond what we would even imagine. So in a way, just like when Abe came in, that juiced the dollar yen. Milei and his success so far has now reduced the risk in Argentina, has increased the return opportunity. I had a great chance to have a meeting with President Milei, Mike Milken, and myself out at the Milken conference. And we spent an hour together. And I was so impressed by the president's conviction of his ideas and how clear his thought was. And he and Mike had a really special relationship. And I'll never forget when we first sat down, Mike said to the president, Mr. President, you know that Argentina has suffered through the last 100 years. It's been up and down. There's been no consistency, and there's been one crisis after another. But there's been people in history that can change history. And he said, I think you're one of the people that can change history. I think you can change history for Argentina, but not only for Argentina. If your ideas and what you're doing works, it's going to help Latin America. It's going to help the United States. It's going to help all global, because this is a great model. This libertarian model is a great model that we could all learn from. And he said to him, but the number one thing you got to do is you really got to focus on the human capital of the Argentine people. You have great human capital in Argentina. They're well educated. They're very, very talented people, and you have to focus on that. And President Milei said, well, Mr. Milken, that's fascinating, because you probably never heard of this guy, but this guy, Gary Becker, is my mentor, and I have a big painting in my house, 4x4 painting of him. And it turns out I don't know who Gary Becker was. Gary Becker is kind of the father of economics with regards to human capital. And Mike said to him, well, Mr. President, actually, he was my partner for 45 years. And I knew him very well, and I spoke at his funeral. And by the way, I have a lot of pictures with him and a lot of other things and memorabilia. I'm going to send it to you. And literally, President Milei, tears started to come down his face. I mean, there's some meetings in your lifetime you sit and you say, I'll just remember that forever. I will remember that meeting forever. It was really special.
And also, I don't have to say anything. I'm just going to be a fly on the wall. We talk a lot about global investing, and the U.S. is 2/3 of world market cap now. And I tell investors who always say, well, it was obvious you should have put all your money in the U.S. back in 1899. And Argentina is often the one that I use as the counterexample. I say, look, if you were sitting around drinking champagne, toasting tea, and New Year's 1899, you probably would have considered Argentina to be equally as good of a bet as this fledgling U.S. country. But as mentioned, a few different leaders, a few different crossroads, and the path becomes a totally choose your own adventure future.
100%. I mean, and that's kind of the secret, especially emerging market investing. The economics will come through, but the politics are the key. And the politics are management. So analyzing a country is like analyzing a company. Politics and who's the leader in management's number one issue. The second thing, then you can have a balance sheet and you have an income statement, just like you do in a company. What's happening to the external balances? What is the fiscal balances? What's the debt level in the country? A number of things. So, but politics and management is the key. And it's very interesting because when I went to Argentina in the early 90s, Milei worked for a gentleman that I used to go see all the time, who was one of the leading economists. And so I used to see all the reports and stuff that Milei did, but I never met him. So we had a nice little laugh about that because the guy that he worked for was quite a character, and we always had some funny discussions. So we were kind of linked, but had never met each other before.
Yeah, well, Argentina is definitely on my bucket list for some skiing,
You should
fly fishing.
Oh my God, it's fantastic. And you can ski there in what's our summer, so it's fantastic.
If you even look at the equity market, it's done quite well in dollar terms the last couple of years. And then I pulled up the ETF, which, again, is only the biggest stocks there, but PE ratio still pretty darn low for a market that's had quite a run.
Yeah, you're buying stocks at very reasonable multiples, if I'd say even low, at trough earnings. So that's the ultimate you want to buy in a market like that. So, there's only a couple of places in the world that we're really bullish on. One of them is Argentina. The other one is India. And those have been two stalwarts for us. We've liked Mexico a lot, but this recent presidential election has made it a little bit more uncertain. And we'll have to see what the new president, whether she can break away from AMLO, which we think she will. And we're going to go down and meet with her in a month or so. But it's not clear there. I mean, the U.S. is still an amazing market to invest in long term, but we're at pretty lofty valuations. The equity risk premium now is at one of the lowest levels in 100 years. And, when you look at ownership in the U.S. equity market, retail owns a higher percentage of their ownership of assets than they've ever had. So it's over-owned, it's expensive, the premium is very low. So there's a lot of risk to the U.S. market here. And I think the next 10 years are going to be very different from the last 10 years. And we're expecting fairly low returns and lots of volatility. We really believe we'll have another crash sometime in the next 10 years. And I define that as down more than 25 in the S&P in less than a month.
I'm always conflicted when I see that chart that you mentioned about how much retail owns as a percentage of their net worth in equities and what percentage own equities, because it is the best contraindicator at peaks as to, S&P movements. But at the same time, I'm like, I want 100% stock ownership in the US. And so I want that trend to be higher, but damn it if it hasn't been amazing at being able to predict, at least on the interim period.
The last two times it's been up at this level was 1969. The next 10 years were a disaster. And then from 99 to 2009, we obviously had the great financial crisis. We also had the collapse of the dot-com, and you also had the corporate fraud in that period. So 99 to 2009 was a very difficult time for the equity market. And the last time...
Good time for macro hedge fund managers,
a great time for us right now, yeah, and then too.
One of the things that you mentioned briefly, you're talking about India, you talked about Mexico, we mentioned Argentina with their leaders. How often, of the macro equation are the sort of geopolitics playing a major role, meaning versus, because I know you do bottom up, you do thematics. How does that kind of really guide your decision-making framework on something as binary as a political election?
We kind of think globally, but invest locally. So the local politics are incredibly important, and predicting elections is a very difficult thing. And the election here in the U.S. is going to be very difficult to figure out what's going to happen, and we don't know. But once the elections kind of occur, if you do your homework, you can kind of figure out what kind of policies they're going to run and are they going to be successful or not. You can put some probabilities around that. And that really creates the opportunities. And there's also usually around elections a lot of volatility and a lot of uncertainty. And that also creates some opportunities. But it can be long or short. I mean, I would say the politics in China are very difficult right now. And I think that Xi just doesn't have the same priorities that the prior leaders of China had leading up to him. His is about unifying China with Taiwan, bringing Taiwan in. It's about keeping power of the Communist Party. It's not about growth. It's not about return to the economy. It's not about having good returns for investors at all. He doesn't, quite frankly, care about any of that. So we think it's going to be a very difficult time in the next decade in China. And that's going to be one of the hallmarks. And when I look geopolitically today, it's more problematic than in my lifetime. And I think when the crash occurs, I think it's going to be geopolitics that creates it, and it's going to come out of nowhere. And we don't know exactly what that is, but it could be. And in Taiwan, we don't think they invade Taiwan. We think they just blockade Taiwan. They don't need to invade it. And there's not much we think the U.S. can do about that. So, but there's other issues, whether you look at the Russian or the Middle East or other places, it's really, you've got a situation where it's a Cold War, but it's not just the U.S. and Russia, or it's Russia, China, and Iran against the West. And this is deteriorating rapidly in our view.
So One of the things that has historically been a constant in markets, as you mentioned, is crisis. You've lived through tequila, ruble, Asian tech, GFC, COVID, whatever's coming next. Any of these specifically stick out in your mind? I mean, is there any one that's particularly the most memorable of all these? Because there's been a bunch.
Well, it's the scariest one, but the great financial crisis in the U.S. is the most memorable because that was really the mother of all crises, because it was at the heart of the major economy in the world. And, I slept in the office for, I think, 3 or 4 months during 2008. It was really scary. And we took total leverage out of our fund. We had everything cash position. We had all our positions in vaults. We were very nervous. And if TARP hadn't happened, we'd all had our deposits frozen. We'd have had a major, major depression. So that was a really scary time. And I don't think we're going to see that in my lifetime again to that extent. But we could see a global war. We've had peace for many years, and we really are not at peace anymore. And that's a big problem. And I do think if China strangles Taiwan, takes it over in a sense, I think you'll get a global crash and a global recession of very big magnitude. It'll make the pandemic look like a small event. So this is a big risk. And, Xi has said that he's going to unify Taiwan, and he tends to do what he says. So we don't know the timing, but we would, put a high probability of the next decade that's going to happen.
Is that a scenario that for anyone that still invests in emerging markets, we joke, most Americans listening to this, they're like, not even discussed anymore. They just forgotten emerging markets,
sure.
Right? They're just like, oh, God, I don't even want.
Yeah.
But China, despite being down quite a bit, is still a pretty large percentage of emerging market indices. Is that something that when you look at kind of the geopolitics of China, do you just say, look, I don't even want to touch it? Or is it something you're like, no, there's some opportunities, or maybe even shorting parts of it? How do you think about something when there's such a massive geopolitical cloud over what could happen?
We think that there's a geopolitical risk, and then there's a change in the philosophy of the country. And it's not about returns anymore. And, in fact, Xi has said we're not going to have excess returns in any industries in our country. You're going to have to share it with the common good. So we think China is a wonderful shorting opportunity, and we've been short for the last 3 years, and it's down about 50% at the low. It's come back a little bit. We adjust our position at higher levels. We are larger than we are today, but I really believe it's going to fall another 50%. And, when I was at Tiger in 95 to 99, the real key, and actually for the whole kind of decade, was Julian basically figured out that you wanted to be short Japan and Asia in general and long the US and the West. And that was the big trade. We did some great stock selection as part of that, but really that was the heart of the trade, and that was very successful. So I think we're looking at a decade, and we're already 3 years into it, where it's long the West and short China and other parts of Asia. And I think that's a fantastic trade. There'll be volatility around it, but that being said, there'll be some opportunities in China on the long side, but I think they'll be few and far between.
There was a tweet we did not too long ago, or maybe in the last year or two, I don't even remember, but it was a blank chart and had 2 dots, a blue and a red one from, I think it was 1990, and then a blue and a red one from recently, and the blue and the red series was inverted. And I was like, could anyone guess what these are? And it was valuation of Japan and American stocks in 1990, and then whatever it was, 2023. And I said, if you could have just made one decision and, sell Japan, buy US,
Yep.
Just make it a career, like just forget about it. And then now
That was a career.
Maybe the reverse.
It may be shifting a little bit, but Japan's interesting. But again, I still think there's better markets.
Yeah. Well, you mentioned India, so let's talk about that. How much of that is Modi driven? How much of it is just this ascendant economy that is seemingly pretty innovative and entrepreneurial and free market oriented? What's the idea there?
Well, I think it starts with Modi. And when Modi came in, he really started the revolution of more market-driven economy. They had all the elements of growth there, and he just has unleashed it. So he's a big part. Again, it's management. He's a big part of it. And it looks like he's at least in for another 4 years. I think that's comforting. We like it. And the growth is there. So it's going to supplant China as the global leader in growth. Already has. There's a lot of companies in India that we're investing a lot of mid caps. So there's a lot of interesting opportunities. We spend a lot of time on India. And next to Argentina, it's our second largest exposure that we have. So it also is a very local dominated market. The foreigners have a less influence on India than almost any market in the world. And the locals are underweight equities. So they own a lot of gold, they own a lot of property, they own a lot of fixed income, but they've never been traditionally in equities. So we're seeing, I think it's something like 53 of the last 56 months, locals have bought the market, no matter what's happening in the world. So in a way, it's a bit of a diversification around the rest of the world, and it's driven by local investment. And we see that just continuing. So to us, it's from a perspective of being low correlation with really potentially high returns. We think it stands out.
When you talk about something like India, for a macro manager like yourself, the menu is not just equities, but bonds, credit, currencies, which you've talked a lot about. How much of it, when you look at something like India, are you doing a thematic, all right, I want exposure to all four of those? Are you analyzing each one individually? How do you kind of approach it?
We look at each asset class individually and what the return can be and the risk we're taking. So it happens in India that we do like the currency because we think it's highly undervalued. They've been intervening a lot to keep it from strengthening. So most countries intervene to keep it from weakening, but they've been keeping it from strengthening. So it's artificially kept lower than it should be. The bonds we like short term because they're going into the global bond index for the first time. And there's like $5 billion each month for the next 6 months going to be bought by foreigners. Foreigners only own 2% of the bond market domestically there. So it's an attractive entry point. So we do like it. So we do have some fixed income exposure. We generally don't have much fixed income exposure ever in India. So this is the one exception, but it's driven by this particular entrance into the index and its reasonable valuations. And like I said, we like the currency, but we don't hedge our equities. And then we do a little bit on hedging our bonds. So we're taking the currency risk by not hedging. But we take active decision in each country whether we hedge or not the currency. Argentina is one where we have a higher weighting to fixed income than we do to equities. We have that because we think the risk reward is a little bit larger and you get such big outsized returns in both the domestic debt and the external debt.
As you talk about currencies, what's the dollar look like? I know it's against every pair, but in general, is the dollar something that should I be maximizing all of my global travel right now?
You probably should be, yes. The dollar's very strong and probably not going to be as strong going forward. The dollar's been an amazing bull market. If I look for the next 10 or 15 years, the dollar probably still is the place to be. But for the next couple of years, you could see some reasonable weakness in the dollar. I think our economy is going to continue to slow. I'm not sure we're going to go into recession, but we have pretty big deficits, both fiscally and current account. And I think the dollar is at a very high level. And the premium we get for interest rates is going to decline relative to other countries. So I think the dollar is going to come under some pressure the next few years. So a good time to get out and travel now.
One of the things we really haven't mentioned much thus far is Europe, which, currently has adjacent or involved in a few conflicts. And what does Europe in general look like?
We generally are net short Europe in equity space, and we are currently. We have a lot of mid-cap names in Germany, for instance, and some of the auto and auto parts suppliers. We think Germany could be in recession or near recession for multiple years. It really is in a difficult spot vis-a-vis China. I mean, they compete against China in so many areas, and we think the Chinese are going to undercut them with a lot of subsidies and just low costs. And so we're very concerned about that. You throw in the Ukraine and Russia situation, which nobody pays attention to anymore, but it really is a big issue that could flare up in a really negative way. You could see gas prices again spike. They're already pretty high. It's kept them very high still. But so competitively, it's very difficult. You're seeing plants shut down in Germany for the first time in many years. We're very concerned about it. There are some individual opportunities we are on the long side in Europe, but in general, we're short the market there relative to what we see in other places. And then the currency, we've been short the euro for a long time, but I think now there might be one more kind of gap down in the euro, 3 or 4 euros. But I think a year from now, the euro will have a 120 or more higher handle on it.
Rob is officially the first person on the podcast that covered a trade while on the recording.
Yes.
We weren't recording yet, so listeners, right. I'm not telling you what it is. But, it's funny because short sellers in general, and most people, when you say short sellers, they think just equity, right? Like they're shorting specific names, the Chanos kind of mindset of the world, but they're, I don't want to say almost extinct, but there's less of them. And in general, it feels like a job skill that is more rare these days, and particularly people that you haven't taken out to the woodshed at some point. Talk to us a little bit about how you guys think about shorting, any of the major pitfalls to avoid, and how much time do you spend on it relative to the long side of the book?
I probably spend a little bit more time on short side than I do on the long side, actually. And especially in these kind of markets where, the last couple of years, our net exposure has been very low. So if you have a low net exposure, you need to have, and you've been net short in some cases the last couple of years, up to 25% in equities and short currencies and fixed income as well. It takes skill to do it. You have to be careful, especially shorting equities, especially shorting individual equities. So we keep a discipline of how large we're going to be in any one position. And we really have to have, in anything that's going to be over 3 or 4%, we have to have a real competitive edge in it and a massive conviction in it. So we only have a few of those ideas in individual things. But when you think of like China, for instance, and we basically have focused more on the financials, like insurance companies, banks, property companies, they're having their 2008 now in China. They're having a very substantial crisis in property. And their property market's much bigger than relative to the economy than ours was. Wealth in the U.S. was about 25 or 30% in property in the 2008 crisis. In China, it's 75% today. It is a big issue. And I don't think they have fully grasped how much and how big the problem is. So they haven't eased enough. So we're going to continue to see, I think, derating and declines in earnings and stocks in China on that side. But, shorting is, you're right. I mean, it's a lost art. I learned from two of the best, in George and Julian. Julian with mainly individual stocks and George with macro. I think that one of the most exciting trades I think that I've ever had was when I was at Tiger, we shorted the Thai bot, and I was responsible for that. And we had a $5 billion short in it. And I'd done a lot of work on the country, and they were losing a lot of reserves. The big problem was that the financial system wasn't really, and it was a property crisis again. A lot of money was in property. They had levered it up. The banks were in significant trouble. And I was just watching the central bank's balance sheet, and they were having to fund the banks every month, and they were saying everything's fine, and obviously it wasn't. The banks couldn't fund themselves. So we knew that they couldn't withstand higher interest rates, and they had a fixed exchange rate essentially, or against a tight band. And they intervened, and we put a $5 billion position on. And the key was, though, that having done this many times in emerging markets, I knew you had to fund yourself out more than a month or so. So we went out 6 months to a year, so they couldn't squeeze us. So when rates went up to 1,000% overnight a few times, we were completely protected. In fact, we actually made money because the forwards blew out. But it was, again, an example of keeping high conviction, because they fought against people like ourselves, and they lowered the lower part of the band to strengthen the currency briefly. So we had a $200 million loss at one time in the position. And Julian just said, Robbie, you still have high conviction? I said, Julian, this is going to go. They can't keep it. It's going to devalue massively. And then on July 1st of 97, 30%. And, I'm only 5'6", but I think I hit my head on the 20-foot ceiling of the room when it came out that night.
How long did that trade take to play out?
It took about
from
3
start
months,
to finish?
about 3.5 months.
Oh, man. How much sleep did you get during that period?
Well, because it was happening at night in Thailand, so not very much. The return was astronomical, and it was probably the most exciting thing that we've ever done. Actually, people say, oh, there's evil speculators, Tiger and Soros, but actually, the country needed to adjust and change, and it actually was a big positive thing for the country long term. A little bit of pain short term, but they did the right thing. They went to a floating exchange rate, and Thailand's done much better since then.
I consistently say on Twitter, which I don't know why I still even get into it, but, short sellers have such a bad reputation. I say, look, everyone almost has it wrong. I said, like, they're the immune system of financial markets. I'm like, you think the government or people, particularly when it comes to equities and fraud and bad behavior, I said, you think anyone else is going to unearth this? Like, you're crazy.
Well, we think in this environment, in particular going forward for the next decade or so, being able to have a short selling ability and a lot of skill in that is just going to pay off in spades.
You were talking on one of your notes about the average age at an investment firm was 34 years old, and not to give you youngins a hard time, but one of the challenges of markets is everyone expects them to play out over the next hour, the next day, the next quarter of the year. But these regimes can often last. And when I say regime, I mean like a very long trend can last a really long time.
Yeah. George used to always say that currencies will go much longer and much further than you ever think. So once the trend starts, it's going to go much longer and much further than you could ever imagine.
Yeah. To the youngins listening, and by the way, you mentioned the word Rolodex earlier.
Yeah.
Young listeners, that used to be a index card carousel where you would write down everyone's name and phone number. Now it's obviously all on your iPhone. But talk to us a little bit about, this regime. We've had a very specific market. You talked a lot about QE and kind of loose money in some of your pieces. If things do kind of change at some point in the future, What do you think are the most likely ways they could change or potential catalysts for why they might?
I think after the crisis in 2008, we went to the easy money policy led by QE, and then it was reinforced with the pandemic in 2020. And so, I think the regime change is just shifting now. We got a little taste for it in 22, where you saw what happened when a lot of liquidity was pulled out of the system. And now we have every country, including Japan, doing QT, some form of it. I think we're now shifting to the new regime. And I think this regime is going to be more normal in the sense that there's going to be a lot more volatility with a little bit less returns and maybe, actually very low returns for the next decade. So I think we're right at that point right now. It doesn't mean that markets can't go up in the near term. It doesn't mean that, everything is going to be negative. It's just going to be a very difficult, lower return environment with much higher volatility. So the attractiveness of just being long stocks is going to be a lot less than it used to be. And not just stocks, but private equity and credit and private credit. And so I see a lot of institutions that have lots of exposures in all those areas with very little protection. And I think that's going to be a problem going forward. They need to find alternatives where you can make some returns, but you also can be protected on the downside.
Well, and everyone has always counted on, bonds to be the savior. And I think I've seen you mention this too before, but everyone assumes that bonds are the negatively correlated crisis alpha. And then you can look back. Antti Ilmanen has this great chart in one of his books. It shows drawdowns in stocks and kind of really bad events. And, for the first part of the 20th century, bonds almost never helped. Which, if you're counting on something like that, is going to be a pretty rude awakening if and when, 2022, that was kind of the playbook, right? Bonds and stocks got hammered.
Yeah, the correlations have shifted now. They were positive, and, it's turning back a little bit now as inflation's come down a fair amount, but it's not clear that inflation is completely dead. And I know that fiscal policies become a big issue around the world among the leaders. When you get central bank governors together or you get finance ministers, the fiscal situation is really dire globally.
As we talk about countries, right, big top down, one of the things that a lot of investors in the US, they'll say a lot of things. They'll make a lot of excuses not to invest internationally. The US has a large percentage of revenues from abroad. I don't feel comfortable. The rule of law, look what just happened in Russia. But one of the things they also say is the sector composition is different, which of course it will be everywhere. How do you sort of tease out when you're doing the top down, bottom up? Can you get attracted to a country like India? Are you thinking, oh, actually, we're most interested in materials and energy? Or is it bottom up where we find a lot of opportunity in techs or mid cap? Or is it just you're go anywhere looking and find out what you may?
We will look at all the different areas, but in certain countries, you're not going to invest in India for commodities, as an example, normally. I mean, there are a couple of good companies in that area, but that's not a special. You're going to look at the consumer, maybe a little bit of technology. In Argentina, you can look at commodities, you can look at oil, you can other things there, agriculture. So it depends on the country and what their strengths are. So we really try to go where the strengths are. But again, you want to find good managements that have a great business plan and are priced reasonably. And so that can be in all kinds of different sectors. I'm not advocating that people invest abroad in passive indices at all. I mean, as you just pointed out, the EM equity index is horrible. I mean, because it's so heavily weighted towards China. So you don't want to be in that. You need to find active managers who can be both long and short in EM and globally these days, I think. But the opportunity space, when you can access, for instance, there's some opportunity in Nigeria, and people say Nigeria. Well, I've been looking at Nigeria for 35 years, and this is the first serious government in 35 years that's really trying to do the right things. And they just had a big devaluation of the currency. It's an interesting time to go in and buy the currency. You can buy bills at 35% yields with a relatively stable, maybe a small devaluation of the currency, but your net return is going to be probably in the 20s, even with some devaluation. And then there's a couple of equities there that serve the consumer in mobile and payments that are very interesting at 3 times earnings. So there's some opportunities there. And we go there. We're not going to have a huge position in Nigeria, but it can be an important contributor to our return for the next couple of years. So there's so many interesting Ecuador, there's so many interesting places to go that having a tool and a lot of toolboxes like we do is really a big advantage for us.
I'd love to see when things line up, looking at history, and some of the sentiment indicators are obviously squishy, but when you see things like the only Nigeria ETF shuts down, to me, like that's almost like a contrary signal. I'm like, oh, that's interesting. Absolutely no one cares about this. We talked on the show, we did this whole series on startup investing in Africa, because I started seeing maybe 4 or 5 years ago a lot of really interesting startups in not just Africa, but in India and surrounding sort of Bangladesh and Pakistan, where you're like, look at these companies, you say, wow, they're seeing very real traction. And eventually that leads through to public companies at some point.
I mean, all the population growth in the world now is in Africa and the Middle East. And Nigeria is kind of leading the pack. It's a very great consumer market moving forward.
What's been the most afar equity market that you've dipped your toe in sort of a Jim Rogers sort of way? Is we've mentioned some that most people would consider to be pretty frontier already, but are there any others where most would be surprised to hear you've had positions?
We've had positions in Ukraine, and we've had positions in Colombia, Indonesia, Malaysia, just about almost any country you can think of, Morocco. So we've done a lot in a lot of different places. I think I've traveled about 50 countries over the 35 years of investing and 25 years here at Discovery.
How do you evaluate kind of, I don't want to call them new assets, but different opportunities? I know you have invested in crypto before as someone who's more of a discretionary macro instead of a systematic trend follower or something. How do you think about including new investments into the toolkit as they come online?
Yeah. I mean, I think in crypto, we got a little bit lucky because there was a great vehicle in the ETF, Grayscale Bitcoin ETF, which went to a 50% discount. And so you were basically buying Bitcoin at 50% off. And we did some work on the legal aspect of it. And then when the case came out and the judges in the discussion, it was obvious that they were going to win and the discount was going to go away. And so when you have a 50% discount, you make like 60% return on that. So and Bitcoin had been beaten up pretty badly. So to us, it was just a fantastic way to invest. And we limited it to us to 5%, and it grew over time. And we kind of kept it until the discount went, and then we reduced our position. And so we have a much smaller position today. I do think there is a place for Bitcoin. I don't know about the other ones, but I think Bitcoin has won the battle. I think it is the Kleenex of tissues or the Coke of sodas. So I think there's a room for that in a portfolio, but again, in modest size at this level. But I think we got lucky that there was a great vehicle to invest. We were able to figure out and comfortable that that discount would go away.
You've talked about a few. We like to ask investors, if you sit down at a table of your peers, so let's call it the macro crew, you're down in Ecuador surfing, or maybe in Argentina drinking some red wine, having a steak, and you guys sit down to have a conversation. And this is more of a framework investment belief. But what's an investing belief that Rob has if he says out loud, so let's say like 2/3, 3/4 of your friends would be like, I don't agree with that. You're crazy, dude. What would you contribute?
I'm going to say that the next 10 years is going to be the decade of Latin America, and it's going to be a very difficult time in Asia. So, especially EM investors, but global investors have really focused more on Asia, and Latin America has been kind of the stepsister. And I think Latin America is going to really shine.
Does that include Brazil too?
Well, I think ultimately the next couple of years might be difficult under Lula's regime, but there's so many good entrepreneurs, so many good companies in Brazil, and it really is a great population of human capital that I think Brazil will be very successful. So I think we need better leadership there. We need better management. So today we don't have much in Brazil, but I think over the next decade it could be a great opportunity. But I do think Mexico, I do think Venezuela is going to turn around when Maduro's out. I think that's the next frontier that's going to be very interesting. We're very interested in what's happening there. We own some of the debt there, and it's 6-7 cents on the dollar. I think we'll make 4 or 5 times our money on that in the next couple of years. And it's just going to be regime change against management change. And we don't know when it's going to happen, but we think it will happen in the next few years. And it could even happen in the next 6 months. So I think it's going to be the decade of Latin America and the lost decade for emerging Asia, including China.
I mean, it's crazy how much impact some of these world leaders can have. You can see what's going on with El Salvador. You can see what's going on in Argentina, a lot of places.
El Salvador is a great example as well.
And both the positive and negative.
Yep. No, absolutely. And we played El Salvador when the bonds got down to 40 cents. And UK's done an amazing job there. It was about law and order and better economic policies. But law and order was really the key.
I went down before he was around, and it definitely was probably one of the more uncomfortable places I've traveled to. I'd like to go back.
Careful.
It's such a beautiful country. All right. So you may have mentioned it already. So if you have to give me the number 2. But we wind these down by asking people most memorable, doesn't have to be the best, most memorable investment you made in your career. And you mentioned the Tide bot. So if that's it, you got to give me number 2.
That was the most memorable. It has to be the dollar yen in 2013. I talked a little bit about that already. But, that was one where the downside was so well protected because they were intervening the currency at 102. We knew they'd have a reflationist policy. You had significant positive carry. It was probably the best risk reward trade of my lifetime. And we put on in size and, for a fund that's reasonable size, make $1 billion is pretty meaningful. So I think that was the best trade. And actually, there was one moment of that trade that was very interesting. So it was actually the day of Sandy Hook being in Connecticut. It was a very tragic day. But it basically sold $1 billion of Apple and bought $1 billion of dollar yen. And Apple went down for the next 9 months pretty substantially, and dollar yen went up dramatically. So one of the best, I think, single day trades that we ever did.
The yen also, and Japanese fixed income in general, has for a long time been a macro battleground. I think we just went over to Japan when the yen was right around 160. So I think we got the timing right. We'll see where it goes from here.
You did. I think dollar yen's going to come down a little bit more, but I really do think over the next 5 or 10 years, dollar yen will see 200.
Rob, it's been a blessing. We've had a lot of fun canvassing the world today. Congratulations on the 25 years. And thanks so much for joining us.
Thank you very much. And good luck to your Broncos, but not too much this week.
A little more than -3 points. That's the line, I think. Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.